Welcome to Multifamily Insights. I'm your host, John Casman, and I'm excited to talk to you today. We've got a fun episode lined up, but before we jump into that, I have to ask you to do a couple of things. One, if this is your first time listening to the show, be sure to hit that subscribe button so you don't miss another episode. And if you're a returning listener, leave us a rating and review so we can learn what you love about the show and how to make it work a little harder for your investing goals. Today, we're talking to Mark Cira. Mark Cira is the co-founder of Cira Capital Group, a firm focused on curating diverse private real estate investments. Now, as the CFO of a consulting firm and a registered CPA, Mark understands the difficulties that busy professionals face when seeking quality real estate operators and investment opportunities. Let's welcome to the show, Mark Cira.
Hey, thanks, John. Really excited to be here. Happy to talk to you today.
Absolutely. Mark, I went over your bio at a very high level. Take a minute or two and give us a little bit more context.
Sure. Well, I'll kind of take it all the way back to the beginning. I graduated with an accounting degree in 2002, and I came out, got my CPA and took the consulting route. I worked for a bunch of firms, through my career, Ernst & Young, Navigant Consulting, did a lot of stuff in project management and utility consulting for clients, a lot of client-facing work. But what I realized was, that's all trading time for hours, hours for money, right? And so eventually you want to build up some sort of passive investments. And I got interested in real estate really through my wife. About halfway through my career, we got married in 2010. Actually, today is our 10-year anniversary. So believe it or not, we're doing this on the air, but so she introduced me to real estate about 10 years ago. And we originally were going to build ourselves a house. And she's a general contractor here in Chicago. So she had been in the business for a long time. I had never really even considered real estate, in my career. Thought it was for, only rich people. So we bought a piece of property that we were going to build our own house. Eventually, it just didn't work out for our own house. So we divided the land, turned it into a development, built 2 single-family homes, and sold those, spec homes. And the light really came on to me at that point, like, hey, we could team up here, and you could build homes. I can invest capital that's coming out of my, my day job, my consulting career. We had built up some, pretty good, 401k balances and all that kind of stuff, just maxing that out, and started looking for alternatives really in building, more homes, and all that sort of thing. So we kept doing that for a couple of years, but realized this is starting to get into a very, busy business for me. Obviously my wife was running a business. I was doing consulting. My career was really, kind of taken off. I had started to work for one of my clients in-house as their CFO, around 2015. And, realized that we needed to take a shift more towards passive investing. So really in 2016, I took up the initiative to really start looking at how do people invest passively in real estate. Multifamily is one of those things, as you know, John. I think we met around then, 2016, 2017, through various networks that we're both involved in, going to conferences, all that sort of stuff. And we made our first passive investments right around then, 2016, 2017, I think. And that really started to turn on another light bulb that was, hey, there's this whole nother world where, people like myself who are busy professionals working a career can take advantage of investments outside of the stock market, right? So you're maxing out your 401k, you're doing things that you think are great, but is that really going to turn into the long-term stream of income that you need to replace your day job? Probably not, unless you're just a megastar. So, time in the market is important, and putting those investments, aside as you're working and earning a high income, you can really snowball that quickly. And that's what we learned over the next couple of years, just continuing to dabble in a variety of things from really, like I said, when I met my wife in 2010 through about, today, actually, we had dabbled in a number of things that we'll probably get into in both passive and active, but really found that passive investing for busy people like myself was the way to go. And so that's
Yeah.
what we're focused on today.
Yeah, Mark. I mean, listen, I appreciate you sharing your journey so far. First of all, happy anniversary. That's
Yeah,
amazing.
thank
And
you.
I've known your lovely wife, Ada, for a while as well. So I'll have to reach out to her and wish her a happy anniversary too. But I
Thanks,
love the
John.
story because investing is such a team sport. We always talk about, especially multifamily investing being a team sport. But the very first teammate is your spouse or significant other. And it's interesting because there's so many couples that I meet and talk to where they and their partner may not be on the same page with investing. Maybe one person sees it as risky, or they don't really understand real estate or investing in general. So it's one of those things that could be a tension point. And here you are, you really didn't have that kind of experience. You said that you thought real estate was only for rich people, but your wife was in the space. She was doing developments, she was building homes, you were working your consulting gig, and then you realized, hey, maybe we can partner together. For a couple who is maybe at that early stage, maybe where you were, they haven't really started investing. One person's interested, maybe the other person's not as interested. What would you say to them to help them get alignment on what their investing goals are and to take that step forward?
Yeah, in our case, usually one or the other has either some experience or a friend or some sort of network. One of them's more interested than the other. They're going to be a step ahead of the other partner in the relationship, I think. And in this case, in my case, Ada, being in the contracting business, had knowledge of how to do this, right? So she was able to kind of guide me through, hey, this is what we need to do to make this happen. So similar, what I would say is somebody's probably got to take the lead and start doing the education, the resources, finding some local networks or mentors or the REI network, whatever it is that you may find. Going to meetups is a great place to start meeting some mentors and those sorts of things. So somebody's kind of got to take the lead, I would say, in learning the ropes. So Ada on the active side provided that for me. Once we got to a point where we started investing passively, I took the lead because I was more interested in finding out how people do this passively. How do they evaluate sponsors and understand whether a sponsor is good, whether a deal is good, whether a market is good, all of that sort of thing, and where to put that. So then the onus came on me to get the education and help deliver that to the spouse, right? And get them comfortable with the investments that you're about to make and explaining the risk, right? Like here's I'm going to take this chunk of, our portfolio and put it with somebody that you don't know, a significant portion, and it's going to be there for 5 to 10 years. How do you feel about that? Let's talk through it.
Yeah, and I think too, it always helps to know what the goals are. And if you're starting from a place of what are we trying to accomplish, and then how do we get there, it's a little easier to ease the tension or whatever. Because listen, if you're trying to get financial freedom or maximize your earning or diversify your portfolio, there's going to be some risk involved, right? So the only thing you can do to mitigate that risk is do a lot of research, get to know people, get to know other people who are in the space, learn from them. That's why the networking is so important. Going to meetups, listen to podcasts like this, reading blogs. You got to educate yourself. And then you have to share that information with your partner, right? And there's got to be a sense of trust there. You got to have a conversation. The other person may not be interested in real estate per se, but they should be interested in the end game, right? If your goal is to travel around the world at 50 or whatever it is, if you're starting from that point of, hey, here's how we get to where we want to be, it's a little easier to have those conversations. So I love what you've done. And, we've been fortunate where my wife and I were always both pretty interested in real estate and seeing it as a path for us to create the lifestyle we wanted. So we didn't have that friction. So it was interesting because when I would talk to couples, I was always a little surprised. I'm like, what do you mean your partner is not interested in gung ho about this? So it took a minute to step back and recognize that a lot of people may not have these kind of financial conversations about the life they want to build and what does life look like 10 years from now, 15 years from now, 20 years from now. And I really do think you have to start with that viewpoint so you can know the road ahead to where you want to travel. Mark, I want to switch
Absolutely,
gears.
John. Real quick, I want to add on to
Yeah,
that point
please.
because that long-term vision is really the key, right? A lot of people, they see they see fancy cars and nice houses and whatnot right now, but they don't have that long-term, what is the goal? And having a shared vision of, like you said, whether it's travel or a bigger house in the country or whatever, a second house, some other type of goal, long into the future, and then plotting that out, literally maybe in a spreadsheet. This is how much we got to save. This is how much we need to invest. And these are the returns we're going to target. And getting alignment around that, and whatever, it doesn't have to be real estate, like you said. It could be buying a car wash or something, whatever that might be, in order to get out of, somebody's day job, if that's what they're wanting to do. Getting that alignment and focusing on that long-term and staying there is the way, like you said.
Yeah. And the thing that's interesting with your path is you started out investing passively. I know that you went to the active side, and now you've kind of almost gone back to more of a passive focus. So talk to me about that, because almost everyone I meet is interested in going, they want to start passive to learn and get their feet wet, get some experience, but they really want to be the active operator. You've done that and kind of have gone backwards. I shouldn't say backwards, but you've kind of looked at that and you've decided, hey, you know what, actually from a lifestyle standpoint, this is really what I want to focus on. Explain to me just what took you through that process, and how did you get from where you started to where you're at today?
Well, there were a number of factors, honestly. When I started 2016, 17, I wanted to do that, learn passively, or learn through passive investing and invest alongside experienced operators. And I seeked out some mentors and got involved with, like Joe Fairless, and really learned the ropes of how to become an active, investor, or sponsor, really. But at the same time, my career was getting, more and more busy. The firm that I had become the CFO of was starting to grow. So I wanted to try to do it in parallel. So we took a couple of small steps into the active world to see, could I support both my CFO role and the active syndication model as, essentially a co-sponsor, and me providing the financial, piece of that sponsorship, right? So, that worked okay for a while, but the bigger your portfolio goes, the larger amount of time you got to spend in that active role. And really, I think it became an underestimation of the amount of time that was going to be required from me personally, as well as the other partners. I think everybody thought that the process was a lot easier of just hiring a property manager, looking at the financial reports that they produce, and they're going to take care of all the maintenance and you're never going to have a problem, right? Well, that's unfortunately not even close to reality.
Man, you just disappointed a lot of people.
Yeah, I know, but it is the truth, right? And it's a job, right? A lot of people think that, hey, I'm going to go out, become a syndicator, going to live this passive lifestyle, but you're creating yourself a new job. And do you want a new job as a real estate professional who has to manage, property managers who, frankly, they're going to have different incentives than you. They may not always be responsive. You cycle through them. There's going to be emergencies. Those things happen. And just understanding when you take a step back, what is my compensation level for doing all of this work as a passive or as a syndicator versus what is my potential, earnings in my day job? And if you compare the two, sometimes you may find that, I can invest this high earning salary into passive investments and probably come out at the same or better place without all of the time. And that's really the calculus that I did. I saw the trajectory of my career exceeding the potential returns in the short term through being a syndicator, and realized that I could really come out the other end with high earnings in my day job and not have to put as much effort into the syndication path. So, I was not trying to exit my career. I like my job, right? That was not, I enjoy the people I work with. A lot of other people, they don't want to be in, a day-to-day W-2 job. And that's not the type of job that I have, right? I'm the CFO of a company It's much different than kind of going to the weekly grind of 40 hours a week and not enjoying it. And I understand why people would want to move and become a syndicator. I'm not saying that there aren't tremendous opportunities out there. There certainly are. But it is a crowded space. And unless you, you have a leg up or are willing to put in much more than the next guy, I think it could be less lucrative.
Really great insights there. You talked about coming in, really starting with the education, investing to learn on the passive side, getting that education, mentorships, partnerships, getting in with different operators. And then as you got into the active space, recognizing how much work was actually involved. And that's everything from, overseeing the property management company, actually having to be more hands-on with those individuals, overseeing any crisis that pops up. And the thing that I think really stands out is people don't really think about this, but what's the real compensation package? There's certainly a couple of fees that are involved, but when you factor in the amount of time, the phone calls, the effort, the time on site, all the management of the asset, the compensation for that in many cases doesn't justify the amount of equity or the amount of compensation that someone's getting on the operator side, especially when you think about what they could be making in a W-2 capacity, or in your case, as a C-suite executive of a firm. So when you start thinking about it from that standpoint, it may make sense for a lot of people to simply invest their money passively, get the passive returns, and don't worry about the headaches. That's what you work with these operators, general partners for, is to find those opportunities to do that heavy lifting. But that's also how they earn their fees and earn their equity component. And it's for a lot of people, if they haven't been on the active side, and I mean truly on the active side, they don't understand or really respect the amount of work and effort goes into it. When you're talking
That's right.
about a large property that has a lot of moving pieces, especially if it's like a C class or B minus property or something that's being repositioned, and you've got different tenants that you're dealing with, and property management issues and contractors. And I mean, there's a lot, there's a lot of moving parts, and that doesn't even get into the human resource and operational components, the filings, the accounting, the lawyers, and all the
Exactly.
paperwork. So, I mean, there's a ton that goes into it. And I'm not saying this to dissuade people. I'm saying this to say, I think what Mark did is the right approach. Start passive, learn, get a sense of what really goes into the process. If you really want to be active, you can take a shot, you can move towards the active side. But I would say that if you have a role, if you have a demanding job, or you have a career that you enjoy, you may be better suited just sticking in that role, earning your passive income, and continue to grow that way.
Exactly. And, one other point on that syndicator model is that often those returns that you're going to earn as the sponsor, they're not coming for 5 years. So you're earning a management fee, but most of that's going to build your own business or back to the people who work for you. You're really not earning much of a salary typically, especially in the early years, right? Until you get a significant portfolio operating, and the management fees are, you can build your salary in. Much of that that really return comes in the back end based on your performance. So, there's a big chance that, hey, the market changes and you don't earn what you thought you were going to. So that is also something to factor in, is the risk that you're taking. So, and that's why a lot of people don't understand that syndicators, what is their job? Why am I paying you these fees? Well, those are the reasons.
Well, and I think the other thing too, from a limited partner standpoint, it's one of the reasons that I know a lot of people like a preferred return, because even in that situation, if the market turns, those investors get priority on the profits.
Absolutely.
So that's something that a lot of people look for. And it's a smart thing to do, because you're right. If that operator either mistimes the market or something goes wrong, at least that portion of profits goes back to that investor first and foremost. So there are a lot of things to look for there. Mark, let's talk more about that, right? We've talked about, why you've made that decision to focus on a passive investing approach. I know you help other people who are similar to you, busy professionals who are looking to invest passively. What are some of the things that you tell them, when they're looking at investing? What are like the top 3 or 4 things to know about investing in a passive capacity for real estate deals?
Sure. I can probably narrow it down to 1 or 2. And I think 80/20 rule, it's all about the sponsor, right? And then within that, you look at their track record. Where have they been? How long have they been doing this? Are they bouncing all over the place with different strategies, or have they really nailed one strategy and that's their core competency? Like I said, I mean, how the sponsor operates and how they treat you, how they communicate, what they've done in the past, how they've responded to problems. Those are the things you want to understand from a sponsor in a passive role. Because I think, most of the returns are going to come from those processes and systems that those sponsors have in place. They've been doing this for 10, 20 years, something like that. They've seen the up and downs in the market. They know that when interest rates change, they've got a projection of what that's going to do to their properties, to their exits, and they've protected their downsides. So for me, as a passive investor, it's all about surviving a downturn in order to thrive in the long term. Because I believe that there are many new operators and syndicators out there who haven't been through those ups and downs. They see rents continuing to increase at paces that we've seen over the last couple of years, which is unrealistic. And they may be underwriting things in a way which do not protect your downside and taking risks that may be outsized in their return potential. So, like I said, I always like to get to know the sponsor. When you understand their criteria and their methods of underwriting and how they do their business, you can lean a lot more on their expertise to find the right deals. And you don't need to spend a lot of time at the deal level if they're doing lots of deals, and you can go back through their track record and see, 90 out of 95 investments were positive. And we talked about the 5 that had a negative outcome or didn't perform to plan. And they have quality explanations for why it went off track or what went wrong with their underwriting estimates, that sort of thing. When you get down to the deal level, sure, IRRs, understanding their expectations that underpin their financial models. So rent escalation, for example, or even, how are they underwriting their tax increases? Because that's often an area where people get blindsided in a deal. They underestimate the amount of tax they're going to pay when they purchase the property, because you're buying it for more than the last guy. The tax assessor is going to come in and see that, and he's going to slap another, whatever percent on. So there are a lot of things at the deal level that if you are investing, one-off deals, you probably want to get involved and understand those assumptions once you've validated that a sponsor meets your criteria of long-term investing. It's got to be somebody that you want to be with for 10 years, 20 years. If they don't have the wherewithal to stand through that amount of time and they're going to be there in 10 or 20 years, then you don't want to invest. You want to know that they're committed. So that is my biggest key, is finding those sponsors that you want to, essentially marry.
Love it, man. You said finding those sponsors that you want to marry. You're celebrating your 10 years, so you understand about those commitments. And that's a really important thing, right? You are entering into a partnership. I know most of the deals that I see are estimating a 5-year hold period, but some of them may go longer, and even if you are only doing one deal that goes 3 to 5 years, you still want to find a partner or an operator that you would want to do business with multiple times, right? You don't want to always be looking for someone new or a new opportunity. So it does make sense to find people who you want to be partnered up with over an extended period of time. And I like the fact that you said, you want to understand the way they think. You don't necessarily want to focus all about the deal. And I think a lot of people make that mistake. They get a deal and they start digging into the deal and the numbers, and not as much with getting to know the operator, the way they think. the assumptions they make, how aggressive or conservative are they? Why do they underwrite the way they underwrite? The numbers are numbers, but sometimes it's more helpful to understand the logic and the strategy that goes into the thinking, because you need to understand how someone's going to pivot. The reality is all the underwriting is wrong.
I was just going to say that the underwriting is 100% going to be wrong. It never goes to plan. So how are they going to react when it does veer off a little bit? So
and that's exactly it. Yeah, you just nailed it. I mean, that's exactly what you're looking for. So it's less about the underwriting, more about the individual. What are their processes? How do they pivot? How do they adjust? Those are the things that you really want to be understanding when you are evaluating different groups. Mark,
and you also real quick, you also mentioned one thing that, the deal is supposed to go 5 years, but if you have a great outcome, you don't want that deal to end. You don't want that relationship to end in 5 years. You want to roll that thing over into a 1031, keep that money with that sponsor, keep it going, avoid those capital gains taxes, and continue that relationship. That's the ultimate goal.
Mark, give me your number one approach right now to finding these great operators.
So over the last couple of years, as the market just continued to get hot and hotter, and you still see, stock market is at, incredible levels of valuation. Same thing in real estate, right? I have really started to dig more into track record and look for diversification. As opposed to what's the best deal out there, because they all look great. Everybody's underwriting their, their best deal, and the market's going to continue on. But really, as I went, back through my history of investing, one bad deal can really ruin a portfolio for many years, because it's very difficult to recover from a big loss. So to me, it's all about looking at, ways to diversify and get into funds and portfolios with operators that have been around for a really long time, and expecting those diversification benefits to accrue over time as you invest for the long term. Rather than what I've found in my own portfolio, I got very excited when I first got interested in passive investing. And you start looking at a deal, you're like, oh, that deal's great, I'm going to go invest in that one. Pretty soon, you've got this concentrated portfolio with maybe one market, Dallas or whatever, one operator, one area. You don't want to be all in Florida if hurricanes come and, you may be out of income for a year. That's not what you want. You want this portfolio that's nice and diverse, not in one area, one market, one sector, one operator. At least in my opinion, those concentrated portfolios could end in significant losses in a portfolio if something goes wrong. And you want to avoid that through diversification. So I focus on those operators that have been around for a long time that have these funds that you can get into 10, 15 properties. Yes, you're going to get a more level return. It's going to be lower than your, mega development deal that might have 25, 35% returns, but it comes with a high level of risk.
Makes a lot of sense there. Mark, for investors who want to learn more about you, what's the best way to reach out and get in touch?
So you can head out to our new website, ciracapitalgroup.com, CIRA capitalgroup.com. Right there on the homepage, you can download our white paper on diversification, and especially around funds and investing, through diversification, essentially.
All right, let's move on to our round of insights, that ROI. Give me a failure or an apparent failure that set you up for later success.
So I think I just mentioned it, which is that concentrated portfolio. And then also, that was one thing leading to the diversification. That's where my focus on success is now. I think the other thing that we talked about today was that path through the active side. I wouldn't necessarily call it failure through, loss of capital, maybe some loss of time, loss of hair, that sort of thing. But a lot of learning came out of that to set me up for where I am today.
Give me a digital or a mobile resource you recommend for your business.
So I spend a lot of time looking at economics. One great resource is from the Global Finance Officers Association. They have a nice dashboard of just real high level economic, macro trends. They also have a city health dashboard that you can really dig into, what are all the metrics driving a different city. So those are two. And then I look at all kinds of stuff out there from the Fed's websites, all kinds of economics data. It's all out there.
Give me the book you've recommended or gifted the most in the last year.
So I really love the book Investing in Real Estate Private Equity by Sean Cook. And it's a very short, almost a manual of how to be a passive investor. Highly recommend it. Definitely, if you're like me, a busy professional who wants to get into passive investing, that's the book you want to pick up.
What's a daily habit that helps you stay focused on your goals?
So I try to pick, a business book, a month or something, and read a chapter or as much as I can in the morning, first thing when I wake up. So get up at 5:30, 6 o'clock, read a chapter before anybody really is awake. There's no noise, drink a cup of coffee and really spend that time reflecting on those lessons that I learned in that chapter that morning.
All right, I know you're in the Chicago area. Give me the best place to grab a bite to eat.
This is a tough question living in Chicago. We are blessed with food here. So, we're going to go to an Italian restaurant in my neighborhood, Franco's, tonight. It's just a nice little neighborhood Italian place. That's one of my favorite places. But, my wife has a list of restaurants and bars that when people ask that question, that's what we send out. And it's, like 50 restaurants long. So, we are lucky here. And that.
A lot of options, man. A lot of options for good eats in Chicago, for sure. All right, Mark, give me your number one insight for multifamily investing.
Well, I believe that it's focusing on the long term. Don't follow the trends. Don't get caught up in, what's the best thing. Focus on the long term, diversify.
There you go. Mark, great information today. I loved you talking about just your journey from getting started, really partnering with your wife and getting started as a passive investor, going from the passive to the active side, and then kind of realizing, I really need to focus more on the passive side. It's not the time commitment, the upside potential. This is where I'm better suited. But then also the fact that you help other people invest passively in these apartment deals and real estate deals as well. For folks who want to get in touch, it's Cira Capital, Cira, ciracapital.com, right?
Cira Capital
Group. Cira Capital Group. Sorry about that. ciracapitalgroup.com is the website. And you've got that white paper available on your website. So be sure to check that out. Mark, thank you for coming on the show. It's great talking to you. And of course, I hope to see you again soon.
Thanks for having me, John. Really appreciate it.